Welcome to CFO 4.0, the future of finance. The CFO role is changing rapidly, moving from cost controller to strategic visionary. And with every change comes opportunity. We are here to help you take advantage of this transition, to win at work, drive your career forwards, and lead with confidence. Join Hannah Munro, Managing Director of ITAS, a financial transformation consultancy, as she interviews key experts to give you real-world advice and guidance on how to transform your processes, people, and data. Welcome to CFO 4.0, the future of finance.
Hello, everybody, and welcome to this episode of CFO 4.0. I'm very excited to announce our returning guest, Jeremy Earnshaw, who is a CFO coach and mentor and is going to talk to us all about mergers and acquisitions. Now, this is the second in a multi-part series, and I want to say thank you to Jeremy for joining me again on the podcast.
Hannah, thank you for the invitation again. The subject is very wide, as you're aware, so very pleased indeed to be able to share some more thoughts with you.
And today we thought we want to talk in deep, get into a bit of a deep dive around how do we structure deals. So I know we're gonna start with disposals and maybe think about, as we go through that process, what the other side looks like as well. So tell us, Jeremy, when you're approaching a deal, what are some of the things that you think about as a CFO?
I think it's important to have a plan, Hannah, and I think you can do this in a very structured way. So if you're approaching a deal on disposals, for example, I think you can put it in the form of an effective ladder and make sure that you don't try to miss out some of those steps on the ladder. So as a starting point for disposals, first point, number one, what are you trying to achieve? Are you trying to, what kind of deal are you trying to structure? Is this a complete money out deal? Is this a deal that secures the future of the business? Is this a deal that maintains some element of control within your organization? All of those things to consider. What are your strategic objectives? Do you want to play a part in the business going forward, even if you're not an owner of the business? And that can be viewed from the perspective of an owner or a management team that isn't part of the ownership structure as well. So I think the first thing on that ladder, determine the desired objectives. I think number two, what is your optimal exit strategy? Is it something that you want to complete all in one go, as an example? Is it a transaction that is going to crystallize and execute a sale, for example, of the complete 100% of the organization on completion? What's the optimal exit strategy? And also think about, if you're selling a business, what's the best kind of remuneration as well for you? It may not be all of cash on day one. It might be something, and we'll get onto this in the next 2 or 3 ladder steps. It might be that a structured exit through cash or other kinds of receipt might be much better for you as well. Number 3, really critical one, assess the readiness of the business and its people and colleagues for sale, because it's a huge exercise. It's another role within the organization. I'd probably suggest the CFO is going to be right at the heart of it, probably managing the project, because everyone thinks we're great project managers. Some of us perhaps aren't, but we're probably going to be in that position of being the project manager and coordinating itself. You probably, speaking maybe out of turn, it's never usually the chief technology officer or the chief revenue officer or the chief marketing officer that gets to be right at the heart of these transactions. It's probably going to be you as a CFO. So are we ready? And it's not just you that's ready. Number one, ask yourself, can the business afford to have me with my eyes somewhere else for maybe 50% plus of the time in my organization? If it can't, you're going to need to backfill the work that you're doing. Equally important, does everybody else understand the demands of somebody and coming peering at your business for maybe an extended period of time. So number 4, what's the business value and the tax implications? So this goes back to number 1, what are your objectives? What do you think the value is? And this is where you can get really good quality advice about how it's valued. What does the sector think? Are there any parallel examples of a sale to trade, sale to who? Sale to trade, venture capital, private equity? Are you thinking of exiting through initial public offering, an IPO, a float? Bearing in mind that 1 in 1,000 companies is managing to exit through that route. So the idea that if that's your ideal strategy, there's a very high risk of failure in that sense, not necessarily because your business is no good, simply it takes an awful lot to crystallize an IPO. So prepare the business and the people, bring as many people into the loop as you can, explain what the issues are about the fact that people will come and do due diligence on your organization. You may wish to do due diligence first yourself, vendor due diligence, and that might well give you a head start into what other people think when they examine your business. We might all have an understanding of what we think our business is, its strengths, its weaknesses. By doing vendor due diligence, somebody else might point out some of the potential deficiencies of your business as well. Execute the strategy. So, how are we going to find ourselves a buyer? Are there any particular buyers that we already know? When we're executing the strategy, examine, for example, are you prepared to share all of your company information with an advisor who may well, unless directed otherwise by you, share all of that information with, for example, your competitive landscape? Do you really want that? Because all of this information, whether it's vendor due diligence or acquirer due diligence, some of your better buyers for your business may well be your biggest competitors. And if they are a credible buyer and if they've got proof of funds, you may well be revealing all of your state secrets as part of this vendor process. So execute the strategy, and then you've got the due diligence, and clearly that's a fairly big ladder step at the end. Whether it's vendor due diligence, I don't think that will preclude an acquirer from doing its own due diligence, and be prepared for people to disagree with you. It's a process which is going to be relatively critical because that's what it's supposed to do. It's there to poke you and find out where the risks are in the organization. So we then get to the idea of closing, and that is leading up to the transaction. We haven't even spoken about what happens afterwards.
And I think that's the bit that when you break it down, actually, there's a huge amount that goes into figuring out how to structure this deal. So if we think about, breaking down those steps, where would you start? Because you said there's a lot of things you need to think about. Where would you start first, personally?
Yeah, I think I'd start by making sure my business is prepared. It's as a CFO, you want to probably more so than colleagues, I think, have a real sense of control about the organization. So you know, as an individual, what the sensitivities are. So I would be stress testing my own business plans. I would be making sure that if challenged on the financial performance and other performance of the business from a commercial point of view, I think asking the questions in advance and having the answers ready is a really important part of the process. You don't really want to be in the position of an acquirer coming to you and pointing out questions which you should know the answers to, for example. And so let's dive into that in a little bit more detail. For example, I might prepare a 3-year business plan, which is very positive, and I might share that with an acquirer, a potential acquirer. If I'm an acquirer on the other side of the desk, I'm probably saying, looks a great business plan. I'm really impressed by it. The first question I'm going to ask is, how accurate are your business plans? Please show me your last 3 business plans that you've prepared and how you delivered against that business plan. And if you then come to me as a disposer and say, I prepared a budget last year, I missed it by 40%. I prepared a budget 2 years ago, I missed it by 33%. I prepared a budget 3 years ago, I missed it by 25%. I'm immediately knocking 40% off your business plan going forward because you have a history of not delivering against plan. So, in thinking about a disposal in particular, the work starts 3 years in advance to start thinking about, do I have two business plans? Do I have a stretch business plan? And do I have a plan which I want to make sure I achieve? Do I want to make sure that I can drill down into the customer split, the revenue split, which where my profits are generated from, where my cash flows are generated from? So I think that internal work, really understanding your business, and it makes you look competent as well when you ask the question. The last thing you want is a lender or a bank or an investor coming to you with a set of questions and you don't know the answer. That's bad for you as an individual going forward because you may well become an employee of the new company, and it's bad for you because you should know.
Yeah, and having that level of detail and the rigor around those finances is so important. Yeah. And people, like you say, they don't always think far enough ahead of this process. It sort of all comes as a bit of a shock when you
Yeah.
go through that due diligence piece. So
It is.
yeah,
I mean, that preparation starts a long time before you hit the execution button. And that's where having a good set of advisors can really work as well. So they can help you by thinking, it's great that you're shooting for the stars with a business plan, but bearing in mind in 2 years when you didn't hit that business plan, somebody's going to say, I don't believe you as a management team. And that's quite critical. That's quite, it's quite awkward to be challenged with that from a buyer that says, I really don't believe you. Because if they don't believe you on that, then it's already forming a crack in that future management relationship, which is, I just don't believe your business plans. Either you're incompetent or you are deliberately setting stretch targets. So make sure you know which one it is. And make sure you know that if I set a budget of 100, I'm really only expecting to get 70, and make sure that's pretty critical. So I think that preparation of the numbers, the internal due diligence that you can do and prepare, splitting your business up, making sure you know the different segment performance, the divisional performance, the customer performance. And we haven't even spoken to a certain extent about some of the contractual hurdles that you may well come across as well. So before you could even get into negotiation with potential buyers, of which there are many, come on to that in a second, um, how many organizations will have, for example, change of control clauses? So your biggest customer, if you have a contract or an agreement with you, let's work out what would happen if you suddenly announced that you were going to be sold to a buyer. Who has change of control clauses? That might include your lenders, it might include your investors, it might include your customers as well. So I'm looking for potential obstacles that might prevent me transacting as well. And we've not even got to the stage of who might be the buyer. Let's consider that. Who might be the buyer? Your competitor who sells the same product or service as you might well be your best buyer because they could take you out of the marketplace. They potentially could get rid of your overhead base. Do you want to share all of your information, like we said before, Hannah, with a potential trade buyer? What about venture capital buyers? What about private equity buyers? That might be bringing in an external investor into your organization for the first time. And we all know that VC, seed capital, private equity investors not necessarily known for their patience. So what's their timescale in buying an organization? What do they want out of it? Do they want a position on the board as well? Do they want their own non-executive to come in and be part of the board going forward? Or are you going to try and IPO the organization as well? So a huge amount of work probably focused in and around that CFO office as well, but being really self-critical, I think, is the answer to making sure that uh, you produce a credible business plan that's really been stress tested before it goes anywhere, absolutely anywhere, that you stress test it, sensitize it yourself, and then you're prepared for the due diligence.
And you mentioned, budgets and plans and thinking ahead on
Mm.
that. You've mentioned thinking about your contracts, both with vendors, with customers, and other areas. What else should you be thinking about in your sort of readiness assessment?
Yeah. I think that there's an element of work to be done around potential buyers, and you want to avoid the tire kickers. Let's be really clear about it. So, when I am putting together a list of potential acquirers, I want to know that this business has the ability to execute and has perhaps a track record of doing so. So, are they able to point you, for example, to case studies where they've said, we acquired company A 2 years
Mm,
ago, go and speak to company A, and they'll tell you how we conducted the due diligence, how we engage with the management team, perhaps more to the point, how they engage with all of the colleagues after the transaction as well. And have they got proof of funds as well? So, are they credible as a buyer? What's the strength of the buyer? For example, if they're offering you as a seller, they might be offering you shares in Bidco, let's call it. Do I want their shares? What's the track record of their share price? Am I being given the right class of share, or is it Class B shares or Class C
mm,
shares where really I don't have as much control as I would like? Um, I'm beginning to ask myself what the structure of the deal is as well. Is it, as we said in the introduction, Hannah, is it lots of cash up front and
mm,
that's the transaction done? Or is it an earn-out deal? Again, you're in a position there, you can be asked a very pointed question by a buyer about earn-outs. And really the same applies to warranties and indemnities as well. If you present a business plan to a potential acquirer, they will ask you, as we've just mentioned, do you believe management team in your business plan? If you answer yes, the answer could well come back, well, you'd be absolutely no problem at all then for you to take an earn-out structure where 50 to 60% of the consideration is based on your business plan. If
mm.
you answer yes, that's where that conversation is heading. If you answer, not really sure about my business plan, it's quite aggressive, the answer, so you don't believe in your business plan, so why should we? So you're in that damned if I do, damned if I don't conversation. And that you can really have a challenge internally before you're given that question by a potential buyer. I'm
So
beginning
in
to ask,
that instant, how
mm,
would you handle that? How would
I
you
think
approach?
there's a price for today and there's a price for tomorrow.
Mm,
So the idea that let's say a business was valued at £1 million.
mm,
Uh, if that was the initial conversation, this goes right back to the start again. What's the initial conversation? Um, if the initial conversation is £1 million on the nail on day
mm,
one, then why would I accept £1 million with half of it structured over 3 years? That just feels like a very different balance between risk and reward.
mm.
If, however, having seen a business plan, having done due diligence, the idea is, well, do you know what? We're not going to give you £1 million day one, but we do like your business plan. We'll give you 600 day one, but the total remuneration might be 1.7 million. Then that begins to become a conversation that's palatable. Um,
Mm,
you've then got to consider if people just chip the price.
yeah.
And then for me, that's a really important point. This is about culture. So, for example, if you've done all of the things that we've talked about, your due diligence has stood up, and then somebody comes along at the 11th hour and says, Yeah, I know I said a million, but you're all invested in the process now. You've all got your eyes on the prize. The price is now 850 for no other reason than, well, you're 6 months into this process now. You don't want to do it again, do you? I've got a problem with that, because if it's
Mm.
not justified, that is how I'm going to be treated as a seller going forward. So it goes back again to your position is, am I going to be an employee of the bidco, or am I exiting completely? But by the way, just chipping the price at the 11th hour because you can doesn't sit easily with me.
And it doesn't set the right relationship tone. You kind of know who you're dealing with
Correct.
as you move forwards.
Yeah.
And like you say, if you're looking to stick around, are those really the people that you can trust
Yeah.
to move forward? And
Yeah.
I think, some great points there. And you mentioned something about valuations. And I guess that's one of the things that's changed dramatically over the last few years, with the changing in the market and
Yeah.
lots of things happening. How do you go about understanding if the valuation's fair, or where you should be sitting as a business? Like,
Yeah.
how would you approach that?
Really good question. And I've done a piece of advisory work through my coaching practice quite recently, actually. There's the standard one. And again, let's not get wrapped up that there's some great science about this. If your business has net assets of 1 million, that's my base point. Why would I
Mm,
sell if you are fortunate enough to own a house worth £1 million, let's say, to keep the numbers round? Why would somebody come along and you accept less than £1 million?
mm,
If somebody's prepared to pay me more for that, I'm wanting to know how you've got to that valuation. So again, this is where you can get some really good advice, and there's lots of information available that you wouldn't necessarily have to pay for as well. So if you're then looking at a valuation, I'm first of all looking for any comparables in the marketplace. So what happens when other people in the sector divest of an organization? What is the benchmark? Is it a multiple of EBITDA? I don't particularly like that method because it's aimed at converting into a cash flow, and EBITDA is not the same as cash flow. Um, but there might be a methodology that says in this sector, the average transactional value for a business being sold at your size is 4 times EBITDA. At that point, I'm saying that's my minimum, 4 times EBITDA. Are there any pluses to that? Maybe I've got some fantastic customers, better than some of my peers in the sector. Are there any negatives to that? Maybe I'm a slightly younger business. Maybe I'm growing more, but I haven't got as much of a track record. Is it a multiple of revenue? I don't particularly like that method either, but if people are prepared to pay it and give people a lot of money, why not? The business I've been helping with fairly recently is actually in cybersecurity. So as a sector, it's very exciting.
mm,
It's growing hugely. It's more about prevention rather than the cure. So it's what I would consider to be quite a toppy sector, and they're talking about in that particular business 4 to 5 to 6 times multiples of revenue. So that's my benchmark. So I can do my financial analysis. I could do, for example, a discounted cash flow or a net present value based on my 5 or 10 year business plan and come up with a figure that's my minimum. So I can support it by science. I can then support it with commercial data, which says, this is what's happening in the marketplace. Why would I accept anything less than what's actually happening in the marketplace? And your advisors will be able to do that for you and make sure you're getting, let's call it the market rate for your organization. The other thing, again, prevailing all of this might be a once in a lifetime transaction. This could be the transaction which realizes 20 plus years maybe of effort. That's a big thing going on in your life. If this is your opportunity, take some really good advice from all the usual suspects, from people who can help you. But it could be a life-changing event, and it's important to get it right if you do.
One of the hardest things, I think, is actually putting into words what it means to work with myself and the team here at ITAS. Because not only are we a financial transformation consultancy, but we do it using Sage technology. So rather than me tell you how awesome we are, let me introduce one of our customers.
I'd recommend ITAS as a Sage partner, not only because of their knowledge that they have on the product itself, Intact, but also their friendly and professional approach to the whole project. They've been incredibly flexible throughout the process, but also challenging us as a customer to really think about what it is that we're after, and ensuring that Intact was actually the correct solution for us to meet our needs, which was really refreshing, rather than feeling we're just being sold a product that they offer. We've got on really well with the whole team. They've been hugely approachable, helpful throughout the whole process, really putting it as at ease if anything we kind of felt we were struggling with or difficult. It really helped us to understand some of the complexities with the new system that's different to other finance systems, things that we just never come across before, like the new dimensions and understanding how that actually works.
And as a CFO, when you're thinking about, doing those calculations, what things would you have ready? You mentioned obviously discounted cash flows, etc., and getting benchmarks. How would you if you go, in terms of guessing all of those things? Would you just purely use advisors when you're a CFO? Would you normally do it yourself? How do you approach it?
A combination of those, and this might be part of your vendor due diligence as well. So rather than effectively wait for somebody to say, put your valuation in a sealed bid by a week on Monday, I might include, for example, in my vendor due diligence, I might give people all of the positives and potentially some of the negatives as well in that vendor due diligence pack. So I'm presenting it's almost like I'm selling a house. Again, I'm selling it with 4 bedrooms or 2 bathrooms or a big garden and a driveway and a garage. In the same way, I'm presenting my business to a potential acquirer. So I'm saying I've had customer A, my biggest customer, for 10 years. Here's some testimonials. I've had customer number 2 for 7 years. This is the kind of commercial agreement that I have with them. I'm saying that I've got a retention rate of my staff, which is less than 10%. Intellectual property is hugely exciting to potential buyers. Am I exposed to, if I'm making a product, for example, who owns the intellectual property? What's in my supply chain? So I cover all of those issues around commercial issues, intellectual properties. Are there any legal issues as well? If I'm selling cross-border, what hoops do I have to jump through to be able to transact? I did quite a number of pan-European deals, and for example, doing deals in Germany, you had to get permission from the Workers' Council. And if they didn't like it, the transaction didn't happen. So just setting out all of those things together with let's call it the financial analysis, discounted cash flow, MPV, multiple of EBITDA, and then that competitor sector analysis that maybe an advisor can support, because not all of transactions in your sector will be public knowledge. So they may well be able to work confidentially and examine some of the transactions that have taken place. And there's your benchmark for evaluation of the business as well.
And you mentioned there global. So, does any of this process change when maybe you've got a global presence or you've got global entities? Anything you would particularly consider in that instance?
I'd probably point out one example that happened when my company at the time was a fully listed company, and we eventually did sell to a very large US listed company. So this was a company that was in the top 20 at the time in terms of revenue of the top companies in the US, a major company. So this was a US listed company buying a UK listed entity. And for those people who aren't aware of what happens, if somebody is a credible bidder and who comes in and you go through the discussions and they offered a price per share, we did all of our analysis of whether that was a good price or an average price. What the US company at the time didn't seem to appreciate was that as a public company, as an example, so this is not necessarily just cross-border, but as a public company, if somebody else, when you go public on that deal, was to come in and say they've offered 280 pence a share, we'll offer 280 pence a share, you are obliged under the FCA regulations to share all of the information that you've already shared with your potential buyer to any other credible bidder, which could be your competitor. So you've got to think very carefully about the information that you're sharing. In my case, the US company came along and they gave me a telephone directory size list of due diligence. And we said, number one, you're not having all of that. We're a public company and there's an element of credibility associated with being a public company. By the way, all of the information that you're asking for, if somebody else was to come in and bid for us, I'm not prepared for that information to be shared with what would be potentially my competitors. And this was a business that wasn't really competing. This was adding on to their commercial profile as well. So we had to very much limit the scope of their due diligence. It still took a while. And that was a very tense conversation because, quite frankly, they didn't understand why I wouldn't give them information. The other things to suggest as well in that process, always have a data room. I mean, it's not in specific answer to your question, but have a data room, have somebody who's in control of that data room, who can put data into it, becomes very important. It needs to be either one person or a selection of approved individuals. And then you avoid that debate of, you said that, no, I didn't, yes, you did, and you fall out about things. If you have a data room, you can say, I put the 5-year business plan into the data room at 9:03 on Wednesday, the 20th. And you can see that it went in. And that's the only version that we're sharing with you. And in some of the disposals that I've been through, Hannah, I had my discussions recorded by an advisor as well, just to make sure that we said, we told you that.
And I think that's a really interesting point. You mentioned there was almost a negotiation around due diligence and what should be
Yeah.
included and what shouldn't. And I guess, how do you find the right balance? Because, obviously you don't want, especially if you're going into that new organization, to be seen as a blocker as a CFO. At the same time, you have a responsibility to the organization you're working with to make sure that you're not overly sharing. So how do you approach finding that balance, and how do you negotiate maybe leaving certain things out?
I think it goes back to a question, which is, why are they buying the business?
Mm,
Because if you get, I think, into the heart of why they're buying the business, and you can really understand what they genuinely want out of
yeah.
this business, you can then tailor your approach to not necessarily being hard-headed and just saying, I can't be bothered to give you that information. You can then tailor that debate around, you don't need to have that information because it's not going to be a showstopper. So going back to, what are the showstoppers? And again, having that conversation up front internally, and maybe with your acquirer, actually, what are you buying the business for? Because I need to
Mm,
know what you're looking for. One, I want to be truthful as a seller. So if you tell me that having customer number one for the next 5 years is absolutely critical, I will prepare due diligence that says these are all of the reasons why I think you will maintain customer number one for the next 5 years. Or
mm,
alternatively, I can say, well, they have a history of retendering every 18 months. And you should be
yeah.
aware of that, because that's maybe a showstopper. If you then come to me and say, I want I want an analysis of the paper clips that you buy every year, because I just want to know how many paper clips you buy, I'm telling them that's not necessary. You don't need to know that.
Mm,
That's going to have no impact on your valuation. So I'm almost turning that question around and saying, you tell me how you valued the business, And then I can give you, if the relationship's good, the information that will help you justify your valuation. And we all know how it works, which is at the end of the process, you may well come up with a due diligence profile that says, that's not quite what I was looking for. And then you're in the position of saying, is it a genuine difference of opinion, or is it, I've moved the goalpost now and I just want to reduce the price because I can? So again, getting to understand, is it because you've got a presence in a retail sector, because you've got a presence in Benelux, for example? What are the really important things? I really want to know that you've got key employees, for example, on proper service contracts, so that I'm not going to have a raft of resignations on day two. Another really important thing, people make the business. So if I've got people on 1 month's notice, I'm thinking about that in my exit process as well, and thinking, who are my key people? If I'm an acquirer, I want to have the person who heads up XYZ departments. I don't want them to be on 1 month notice periods. I want them to be here for the duration. And then that protects me. Ultimately, people can leave the business when they choose, with a notice period anyway. But I'm securing the things, hopefully, that might go wrong for an acquirer.
Absolutely. And I think today is very much about being acquired. And I think there's a whole raft of further questions potentially around that acquiring piece, and things to think about, and ways it can go wrong. And I think that's what's really interesting, Jeremy, sort of sitting on the outside of this, is that the level of effort that goes into the work before, in terms of the preparation, it isn't really spoken about as much in when people talk about selling a business. They talk about the price point, the integration afterwards. But what's really interesting, I think, from my perspective, is listening to almost the preparation cycle is longer, or as long, 3 years ahead, as even the earnout potentially, which is a really interesting piece.
And I think poking into those, let's take a couple of key areas. I'd quite like to know that the revenues are sustainable going forward. And I think in my whole career as an executive, I only ever had one contract that I would describe as a take or pay contract. It literally was a contract. It happened to be in a French organization, actually, where we were contracted to sell 1 million widgets, for example. And if they didn't buy the 1 million widgets, they paid for it. I've had one of those contracts in 30 years. So we all know that customers can disappear with the freedom of choice. But I can produce as much information about that, about why my customer is tied into my organization. I can do the same on my supply chain. If my biggest supplier, for whatever reason, chose not to supply me, what are my options? Am I completely lost in the marketplace? What's the intellectual property? Am I equally, am I also tied in to some of those customers and suppliers where I might not wish to be? And that might be a problem for the acquirer as well. So I think that preparation and challenging your own internal people as well. So having that robust debate with the chief revenue officer, for example, imagine the conversation. We've got somebody coming in, the owners might be about to potentially make a lot of money. They're going to challenge not just the CFO, they're going to challenge the chief revenue officer. And that needs to be a structured debate as well. It can't be somebody shooting from the hip in a way that might put people off to buy that organization. So all of that work up front. One thing I would say in structuring a disposal, a non-disclosure agreement or a confidentiality agreement, if it takes more than 24 to 48 hours to agree a non-disclosure agreement, think about how long it's going to take to structure a sale and purchase agreement. It can give you an idea about whether people allow the lawyers to run the process, or whether the management team of the acquirer is running the process as well. So just so many things to think about up front. Are there any competition commission issues as well that prevent you becoming a bigger player in your marketplace. All of those things, and we've actually really just scratched the surface.
I know. I always find this with you, Jeremy, which I think speaks to you as a coach and a mentor. Every time I come into these conversations, I walk away with lots answered, but also a whole raft of new questions to ask you as we get to the end of this. So I'm going to ask you one final question because I'm very aware, and all of the CFOs that are listening to this are screaming to me right now. They're like, keep going, keep asking questions, probably. But guys, don't worry. Jeremy has promised me at least one other podcast, so I will keep. So make sure you send them in. As you get so if you had to say what are the top 5 things that CFO of a business today can do to assess their readiness to sell in 3 years, what would those 5 things be?
I think number one, be in control of your own data. You would expect people in the CFO role, I think, to be able to do that. It's like presenting to a board. You don't want to be caught out by releasing information to a board or stakeholders that you've not thought about what the responsive question might be.
Yeah.
And somebody gave me some great advice 30 odd years ago in presenting information. It was happened to be in the context of taking exams, actually. It was one of my old lecturers who said, Jeremy, don't ever just hope that the question you don't really want to get asked doesn't come up. Prepare for the question that is the difficult one. And if it doesn't come up, it doesn't matter. And the same, I think, prepare for those questions. So get your own house in order in terms of the financials. Number two, I think I would be inclined to do vendor due diligence. It's always worth having, I think, another pair of eyes to be able to do that. Number three, I think have an effective and a sensible view of the valuation. It's all very well saying the minimum price for this acquisition is X, but if the marketplace says otherwise, how are you going to justify that? One of the biggest deals I ever did, it would happen to be on the other side. It was an acquisition. I was told that the minimum price for this business was £140 million, and I was also told you can't afford it. Fast forward 9 months, we bought that business, and we bought it with a combination of cash and shares in our own company, and we paid £82 million for that. So the expectations of that business were ridiculously high, and we did nothing clever. We just pointed out the fact that this was the marketplace. And by the way, there weren't many bidders for the organization either. I think in preparing for sale again, I focus upon the people in the organization as well. How is it going to affect them? Because the business is going to run on people. How are they going to approach that? So number four, I think perhaps maybe split the levels of interest between the sellers, maybe the owner managers, the shareholders, and the people who are going to be responsible for running this organization going forward. And I'd say number five, what's the culture like? And you can gain an awful lot by going through that negotiation and due diligence process. And even though they might be quite difficult conversations in going through a due diligence process, if the way that it's been handled is professional, courteous, robust, but you can see where they're coming from, that might be a good indicator about how it would be post completion as well. Because the other thing that might happen is, as senior managers in an organization, the CFO might be one particular person who's in this category. You may well be being asked to stay with the bidding organization for a period of time. You might well have a lock-in. And I've been in that situation where, to take the example I gave you about the US company, I had to stay with that organization for 18 months. And I reviewed as to as to whether that was a good idea or a bad idea. I think it was a relatively good idea, but just understanding the culture of the organization that you are going to be a part of as a manager. So those 5 things I would put in my list.
Amazing. Well, thank you so much, Jeremy. And to all of our listeners, if you have questions off the back of today's topics that you feel like we should be delving into, or things I didn't think to ask and that you want to know the answer to, then of course, please do reach out to me and I will add it or sneak it into maybe another podcast. So I'd love to hear from you. And Jeremy, obviously, this is your day job. You do this supporting and helping CFOs day in, day out. If people want to learn more about you and what you do and how you do it, where is the best place to find you?
Best place to find me is on my website, which is clarendoncoaching, all one word.com. I do my own podcast, which is Clarendon Chronicles, which is on YouTube. So / Jeremy Earnshaw. And my coaching practice is all aimed at trying to help people in not just finance, but I think 50% of my clients are in finance. It's about helping people with the things which aren't in the textbook. And unfortunately, you need to get a few things wrong as well to be able to help people to do that. And you get things wrong over the course of 30 odd years or so. And the value, I think, of somebody getting any coaching and mentoring is coaching. You've probably got a series of issues, a particular conversation, and you can help them change and perform better in that particular sphere, that particular area. Mentoring, particularly in the finance area, there is an element of I understand where you have been in your boardroom and being challenged with some of those areas. So I think it's important that people see coaching and mentoring in that light. It's not somebody telling you what to do. It's perhaps sharing some experiences and helping you, if you're in that mentoring situation, able to grow as an individual, and in the coaching conversation, being able to put yourself in the position of helping the coachee make better and more long-lasting decisions for improvement.
Amazing. Well, thank you so much, Jeremy. Thank you to our listeners. And if you have enjoyed this podcast, then please, of course, please do share it, and leave us a review, because reviews tell us we're on the right track. So thanks again for listening to this podcast, and I can't wait to see you next time. Take care, guys, and speak to you soon.
Hey Google, what's the best accounting software for my business? Give it a couple of years, and I bet you she'll be able to answer you pretty accurately. But for now, it's still one of the few questions Google can't give you an answer for. But we can. Take our free quiz and find out which Sage product is the right fit for your business. Just head to itassolutions.co.uk.